Now for a quick disclaimer. Nothing you see or hear on the flight deck is investment advice. Nothing said today is intended as investment advice. Those participating in today's discussion may have bought, held, and/or sold the stocks discussed today prior to today's discussion and/or may do so afterwards. Remember, you are responsible for your own investment decisions, and if in doubt, you should seek advice from an independent financial advisor. Stocks can be high risk, and you may lose the entire amount you have invested. Please now sit back and enjoy the flight.
Buying a house, huh? Sweet. Well, I mean the house part is, but the applying for a loan part? Ugh, just thinking about it makes your brain hurt. Skip the pain and make a beeline for your new front door today. And cue confetti. Here's to one hell of a housewarming party.
Hello, and welcome to the Flight Deck. Today's episode 14, and it's Monday, the 18th of May. This episode is going to look at a different sector investment rather than a resource stock that we normally cover. It's a bricks and mortar play being disrupted by applied AI and taking real world assets into the digital age, traditional finance that's ripe for an overhaul. So I'm skating to where I see the puck heading to invest in advance, and I've invited Nick Liuzza, the founder and CEO of Beeline Holdings, to join me today to talk about the two sides of the business, a mortgage platform, and in the second half, we'll look at Beeline Equity that I think has dramatic potential. A fund manager asked me to look at this, found it really interesting, and I couldn't under good conscience not share this company with you. So it's outside of our normal wheelhouse, but stick with it, have a listen. I think it has dramatic potential. So I've invested and taken a small chunk of stock, and I'm gonna stick with the story and see how this unfolds. Nick, welcome. How are you today?
Thank you, Flight. I'm doing very well. I appreciate the opportunity to speak with you today.
It's great to have you. And as I've looked at it, really excited for the potential. So what is it? We'll look at two elements of your company in the traditional finance market, TradFi. Beeline, from what I've researched, Beeline are placing themselves at the intersection of traditional finance as an independent mortgage provider and a digital asset facilitator through Beeline Equity. That helps real estate owners access the equity in their homes. That's kind of the two elements. Nick, why don't we start with you? Who are you as a founder? Can you give me an example of, say, past companies and exit and what you achieved for shareholders in the past? And then how did that lead you in your journey to starting Beeline Holdings?
Yeah, well, I'm a New Orleans boy from New Orleans, Louisiana, born on the Bayou. And my wife is a New Englander. And so we were living down in Louisiana, and she decided she wanted to move to Rhode Island, and I agreed. So I moved myself up to Rhode Island and decided to start a title company called Linear Title back in 2005. Linear Title, what a title company does is they provide closing services and title services for mortgage lenders. In the U.S., you cannot close a mortgage loan without a title company. And Linear Title became the second largest privately held title agency in the U.S. over a course of about 10 years. And it was a huge success story because we merged with a company called Real Matters and went public on the TSX. It was a Canadian-based company that we merged with. This particular company provided U.S.-based services to mortgage lenders, similar to what we did, but a different type of service. And they were based in Canada. So we went public on the TSX at about $1 billion valuation. We grew the company to about $2 billion. And I returned about 100 times to our shareholders on about $1 million investment. So it was a very successful journey. Along the way, though, myself and my team learned that the mortgage industry in the U.S. was broken. We were providing, like I said, services to these mortgage companies. And since it was broken, we figured that, hey, let's jump back in and do something cool, and let's disrupt this industry, and let's focus on the younger generation, the millennials and the Gen Z, the guys that grew up with these phones in their pockets when they were 7, 8, 9 years old, right? And the way that they communicate, the way that they make decisions, the way that they shop is completely different than the way I did and the way that you did and the way that we do. And so we built a mortgage platform for that generation because that generation already represents about 38% of all home purchases in the US, and they're just getting started. So what we did is we built a proprietary platform with a big brand that speaks to them, that allows them 24/7 access to complete a mortgage in real time and allows them to get real-time access to information and data that has a 90% certainty. And so what does that generation like to do? They like to shop without talking to people. They like to make decisions without talking to people, and they like to look at reliable data. And so that's what we built. And when we launched, it was a good market, right? Beeline went from cold start, zero brand, no one knew who we were, to closing 100 loans a month, 120 days later, and running at 15 million in revenue. And we felt pretty good about ourselves.
Yeah.
That's kind of how we got started.
So previously, you made shareholders about 100x. You have a track record as a
Yeah,
founder,
yeah,
and you took that all the way through
we
to
did.
listing and then to exit. What did you see as broken?
Well, listen, I mean, what mortgage lenders buy leads or trigger, they call it trigger leads for the most part. And the way they engage with the customer, is through traditional methods that don't really take into consideration how the new generation wants to engage. They don't want phone calls. They don't want emails. They would like to shop online. They'd like to shop on the web. And so it kind of starts there, right? But we're building splash pages and web pages and we're putting them all over the web and we're creating marketing content all over the web and we're driving them to these splash pages which give them information and at some point in time they end up on our website, applying for a mortgage if that's what they're looking for. And so it's kind of a pathway through the web to get to where we are. And that was the first thing that we saw that was a little broken because you have this generation that is shopping for mortgage and they're not picking up phone calls, they're not looking at direct mail, they're not returning emails, and that's how the industry was engaging or trying to find their customers. And this whole demographic, was not about that.
So you're seeing some success with the webhooks you've got out there
Yeah,
driving traffic to
we are.
your site. So have you got any metrics of the demand that's behind that?
Yeah, well, look, we get a lot of web views. We get between 10 and 30,000 web views a month, depending where the interest rates are, right? And so that's a lot of people that are coming to a small little company that's just starting to emerge and just starting to grow, right? And so we see about, like I said, 10 to 30,000 people that are looking at our website. And we take about 1,000 applications a month. That are people that go through our point of sale, which is the application. We call the mortgage application our point of sale. And so they go through the point of sale, they fill out an application, and we're taking about 1,000 applications a month.
Okay. Where are you capitalized at the moment? So your market cap is around.
Well, yeah, our market cap fluctuates, between 40 and 80 million, right? Basically, our stock has been a little volatile, and so it fluctuates between 40 and 80 million, basically.
Okay. And the shares outstanding?
31.5 million.
31.5. Okay, that just helps set the context. Okay, so you're getting about 1,000 applications a month?
Yeah, and now remember, only about 10% of those actually close. For a lot of reasons. There is a pretty high denial rate in the mortgage space. If you're applying for a cash out refi, that has a really high denial rate. And if you're shopping for a home, a lot of that times those transactions don't close for whatever reason. The buyer may back out, the appraised value doesn't come in right. So at the end of the day, 1,000 digital applications that come in, only about 10% of those are actually closing and getting to the tape.
Are they regular applications? Because as a Gen Z, it's like the gig economy, isn't it? So it's not often standard paychecks every month.
Yeah, it's a good question because the application only takes about 7 to 8 minutes. You go through this online journey. It's very warm and friendly, very colorful. It's designed really for people that were playing video games when they're very young. And so it makes you feel really cool. The verbiage is relaxed. We have our own chatbot right there. That's an AI driven chatbot that answers the questions in sort of our speak and our language, the way that we would communicate, which is very relaxed.
Mm.
And so the whole intent is to take the friction out of a stressful process. Applying for a mortgage is a stressful process. So we're trying to create an ambiance where the mortgage borrower is comfortable, and that's what we're doing.
Mm. So in terms of traditional mortgage loans, That takes 30 days to complete or transact.
Well, no, I mean, we're getting to the table in about 15 to 25 days, give or take, somewhere around there. So we're doing it a lot faster. We're using AI and we're using, an automated process and yeah.
Yeah, so that's where you're starting to sort of bring a efficiency drive just using modern technology. Why don't we just look at that product suite then of what you have? So you've got a mortgage platform, direct to consumer, origination of conventional mortgages.
Actually, Flight, we do conventional mortgages, which are backed by Freddie, Fannie here in the US, but we also do what's called non-qualified mortgages as well. And those are the mortgages that are really designed for this next generation, if you will, because the Freddie Fannie mortgage, the mortgages backed by the US government, those standards were written a long time ago. And we do offer those mortgages and we love that product, right? But when you think about the younger generation, they're not working for paychecks like you and I did back in the day. And I mean, some of them are obviously, but a large percentage of them are influencers or consultants. They have multiple jobs and they're not necessarily receiving W-2 income, they're receiving self-employed income. And as a result of that, it's a little more difficult for them to qualify for these Freddie Fannie mortgages. So one of the mortgages we offer is called a bank statement mortgage, where we just look at the bank statement and we look at the ebbs and flows, and it's kind of a common sense loan, right? It's like if you have enough cash in your bank account at the end of the month to pay your mortgage and your bills, and you've got a good credit score, then you're probably going to get approved for that. So the very large lenders in the US, like Bank of America or Rocket Mortgage, if you don't qualify for a conventional mortgage, it's game over. You're denied. You can't get a mortgage. In our instance, we will offer you that, but if you can't get that, then we'll offer you these other products. So inside of our mortgage origination platform, we have multiple products that are a bit different than some of the very large lenders.
So you offer conforming and non-conforming mortgages.
That's correct.
And then so within that platform, you've then got an AI agent that leads people through the process.
His name is Bob. Again, we're keeping cool and relaxed and, and trying to make everyone feel comfortable. I mean, I've never met a Bob that I didn't like. He's there to make you feel comfortable. He can answer the questions when you're going to the point of sale or before you even start the point of sale / application. He can answer your questions as well. And he can always connect you to a live person. A live person is always available, but he can also help you if that's what you like. And again, that generation likes to speak to bots.
And is that helping with lead conversions?
Absolutely. I mean, we're seeing a much higher lead conversion when Bob is involved, almost 6 to 1, actually better when Bob is involved. The conversations, it doesn't stop. Like, if you don't have a bot or we have the bot off for some reason, if we're doing some testing, right? Which happens sometimes. You see that the process could be a bit disjointed and trying to locate someone to speak. Whereas Bob he's right there. He's not going anywhere.
So you've got the mortgage platform, the AI agent Bob, and then you've got Link QC, which I think is sales as a service, which is that on the
It's an
title side?
early stage product for us right now. Very early stage, yeah, and so it's a QC product is what it is, but we're not generating revenue from that product at the moment.
Not at the moment, but that's something in development. It's basically using your tech that other mortgage lenders could use.
Exactly. It's a QC product. You have to QC your work in the US. 10% of your files for Freddie Fannie have to be QC'd, and this product automates that process for you. But I said it's early stage with that particular product. We do have some integrations in place, but in some other priorities have slowed that development down a little bit, which we can get into in a second.
What I'm hearing is your years of experience in this industry has led you to see how innovative technology, AI application is speeding and streamlining the process, efficiencies, and just allowing you to not only verify but transact things in such a swift time. So I guess your internal rates of return are better than traditional lenders.
The mortgage industry is a little upside down right now because inflation is high and the rates are high. So loan economics are not great on the conventional side.
Right.
On the non-QM, the bank statement and the DSCR loans, these other loans that we have, they are better, and you do see positive economics, but you don't necessarily see great economics on the conventional side. For example, there is a mortgage lender out there, a publicly traded mortgage lender that exclusively, focuses on conventional. In fact, there's several of them. I think there's 8 publicly traded lenders out there, Beeline being one of them, and they're losing a lot of money, 70 million in the quarter. The other one lost around 25 million. I mean, these are big losses that are happening in the industry at the moment.
Overheads are still remain high. traditional high streets. They've got those facilities to
Well,
cover.
yeah, and it has to do with the fact that you're underwriting to an individual and you're matching that to the Freddie Fannie standards, which have been around for a long time. And so that cost to underwrite the individual, it's very expensive from a workflow standpoint. And you got to remember, margins are suppressed. So you've got this high cost with suppressed margins, and the loan economics aren't great for conventional mortgages in the space, which is why we've shifted more of our business toward the non-qualified mortgages where the margins are higher and the underwriting is easier.
Yeah, gotcha. So what I'm hearing really is the first part of this business is bringing traditional finance kind of into the digital agentic age, processing efficiencies. Do you have a metric on like what the cost is on loan generation?
You can Google this. It's like $11,000 to close a loan. That's the cost of origin. Now that includes your CAC, your cost of acquisition cost, and the commissions you pay your loan officers, the production cost involved in that, and then sort of all of the other hard costs involved in it. And right now, the average is about $9 to $10,000. So on the conventional side, most of the loans are negative for lenders like Rocket Mortgage and a couple other mortgages that are massive and they've been around for a long time and they've got their vendors in a really good spot. They're not losing money on a loan by loan basis. But you've got 871 independent mortgage bankers, which is what we are. We're an independent mortgage banker. And a lot of independent mortgage bankers have upside down economics as it relates to the Freddie Fannie mortgages.
Do you have like a run rate, internal run rate that you're trying to hit on that?
Yeah, good question. So like right now, our goal is to hit 700 transactions a month by the end of 2027. And that puts us on a $100 million run rate.
Okay. Do you want to say that? Do you want to say that again?
Yeah, so 700 transactions a month will generate approximately a run rate of $100 million.
Mm. On a $100 million run rate, at a 5 to 10 multiple, that's 500 million to $1 billion valuation.
Yeah, that's correct. And in a normal market, remember Flight, we talked about how Beeline got out of the gate so fast from 0 closings to over 100 closings in 90 days. That was a normal rate environment market. And I suspect that, we'll get there at some point and Beeline will be able to grow its revenue very quickly and achieve our goal. Now we are trading them lower. Now, listen, we in March we closed 114 loans. In April we closed 95 loans, right? And so we've got a long way to go. We got 7 times to go by the end of 2027. Now, when in a normal market, if rates were not elevated like they are now and inflation was not elevated as it is now, we would get there probably, in a year if that was the case. But we haven't been in a normal market for a very long time. And that's the reason why. And so all mortgage lenders out there are really tied to the 10-year in terms of, where that rate is. And the lower the rate, the more business they have. And so if we were in a low rate environment, I would be very optimistic about us getting there in 12 months. But since the rate environment and inflation are where they are and we are in a war, we kind of put the clock as longer than a year to get there.
Yeah, that's understandable. The macro picture, we a spike in inflation, but over time that'll normalize. And I think actually prior to that war scenario, we were looking at perhaps 2 cuts this year. So we should come back to revert to the mean.
Yeah.
Um,
Well, let me get one thing on what you said. In October, our October revenue was up 27% from September to October, right? And that's because we got a rate cut in September. So when October got here, we felt like, okay, we're going to be cash flow positive, in Q1 because we had that 27% increase. Our lending entity was cash flow positive, and all the data we were looking at from Freddie Fannie and the mortgage banker security was like we were going to get a rate cut in December and then another rate cut in February. And so we felt really good about where we were, but what ended up happening was no rate cut in December, no rate cut in February, a war and sticky inflation, and it just completely turned the industry upside down, basically.
yeah, it's a good point. So the Q1 forecast was missed, and I think that combined with expectation of needing more cash injection has put downward pressure on the share price. And currently, I see a great setup here as a result. So you founded the company, and I believe you've invested $16 million.
That's correct.
When I'm looking at a company and when I'm looking at management and skin in the game, I love that story all day long.
Yeah.
Do you want to just talk through that timeline of that investment? Was that in one chunk?
No, that was over a year period. Just I basically invested in every single round that we had.
Mm,
But it was over a period of time, yes.
okay. And you personally own, what's your percentage of the company?
Let's see. It is about with my warrants, it's about 22%, 23%.
Right. So we're fully aligned, you and I. Fully aligned. Okay, so that sounds like applying digital technology over kind of like a bricks and mortar type play.
That is a great way to say it. That's exactly what we're doing is we're basically bringing digital process to an old lethargic system and creating a better outcome for people that want a better outcome. Again, the 141 millennial Gen Zs that are sitting out there.
Okay, look, why don't we get into Beeline Equity? Because this is the thing that really caught my eye. It's a new, unique product. I just think it's a game changer, absolute game changer. Why don't you take us through it, Nick? What is Beeline Equity?
Yeah, I gotta tell you, I move around on that because it's such an exciting product. I mean, we're the only company out there that has this particular product at the moment. And the product is designed for baby boomers who live in the top 20% zip codes of the US. It's for people who are outliving their retirement. You think about Mick Jagger or Keith Richards, they're 82 years old and they're getting ready to go on tour again.
That's
Who,
outrageous, isn't it?
who thought those guys would even be alive, much less touring at 82 years old? The point that we're making here is that people are outliving their retirement at a much faster pace than anyone expected. And as a result of that, their planning that they did for retirement is not working out and they're outliving what they had planned. And so their opportunity to create liquidity isn't necessarily great. Now, the biggest asset that many of these people have, and again, we're talking about the top 20% zip codes, are their homes. So I would say that they are, and the stats back me up, they are cash poor, equity rich. And so enter Beeline Equity, which allows these homeowners to sell a portion of their home for cash, get that cash very quickly, and not have to pay it back. Basically, we take a position, an equity position on the deed, and we sit there until the home is sold. And once the home is sold, we get paid back.
It's a one-off transaction, equity release for the homeowner. It's not a loan.
So we record what's called a deed. A deed is a ownership instrument that's recorded in the public record, which proves that it's not a loan. There's no interest, there's no principal, there's no payments. It's pure equity. We have no rights to the property. The only right we have is to sit on title with the percentage that we own and to get paid back when the property is sold. And that's it.
Okay.
Now, I'm sure you're wondering, Flight, how do we do that? How are we able to pull that off, right? And so the way that we are is that we do the transaction at a 20% discount to market. And so if your home is worth $1,000,000, you have to be willing to do the transaction at a $1,000 valuation. So if you want $200,000, instead of recording 20%, we record 22%. So we own a slightly more because we're buying at a lower valuation. And then there's 8.5% fees on top of that, right? So if it's a $200,000 transaction, then there's $17,000 in fees. And you can pay that up front, but most people decide to put that on the back end, and we take a little bit more equity pro rata, and then that's paid back again when the property is sold. So when you first think about, wow, that sounds like a very hefty fee. Well, if you compare it to a reverse mortgage, which is a transaction which allows baby boomers to liquidate parts of their homes, it's not even close. The reverse mortgage is up here, and the home equity product, Beeline Equity, is much less expensive. If you compare it to a cash out refi, which most baby boomers can't qualify for, the cash out refi is less expensive over a 7 to 8 year period, but then it flips and the Beeline Equity becomes less expensive because you don't have that principal and interest element. You're not paying P&I like you're paying on the mortgage or the cash out refi. You don't have that on our piece. So it becomes less expensive over time. But even if you were to compare it like on a 7 year period, it's very close. And then the economics turn after 7 years. So it's not a punitive product at all. There are HEI products out there in the US which are very punitive. They're called home equity investments. They're not really home equity. They're really liens. Those products they were very popular, but the regulators in the US are after those products because they're punitive. They pose themselves as being equity, but they really turn into a loan after. And so it's really a derivative type instrument. Now, there are some other benefits to the Beeline Equity product. For example, under the IRS code, if you sell a portion of your house, the first $250,000 up to $500,000 if you own the home but jointly with your wife, you don't have taxes on that. So if you sell your property, you have property taxes to pay. In this transaction, there's no taxes up to $500,000. There's no realtor fees. There's no legal fees, right? Just that 8.5% fee at the end of the day. So we make it very simple with no appraisal, no credit check. We calculate the consensus market value, take 20% from that, and we're off to the races.
So how do you fund it? How should we think about your platform? Are you taking the balance sheet risk?
Yeah, so our platform, is a diversified platform which offers conventional mortgages, non-qualified mortgages, and now Beeline Equity. It's a unique platform that no one else has in the US with all three of those products. It's a real estate services platform at the end of the day because of the Beeline Equity component. Now, the way that we fund our transactions, if it's a mortgage, we underwrite, we basically close the loan, we fund the loan with our warehouse line, and then we basically sell that loan to an investor, and then we pay ourselves back on our warehouse line. And that's how we do that business. So we had the balance sheet risk on our balance sheet for about 2 or 3 weeks until we sell the loan. So we don't take the risk at all. On the Beeline Equity side, that is a very unique product, and it's a little bit different, right? We have a partner called TYTL, which leverages the blockchain in order to fund these transactions. And that's the key reason why we are able to offer the product with the terms that we offer is because our partner is leveraging the blockchain. And so at the end of the day, when you think about our platform, again, it's completely diversified and it's unlike any other platform that's out there because of the non-qualified products, the conventional products, and the Beeline Equity product.
I think for me, this is where the story gets interesting, applying kind of real world assets kind of into the digital domain. And so, how do you see institutions coming in and perhaps buying the other side?
Yeah, well, that's happening right now. I mean, the our partner, TYTL, is having conversations with institutions to scale that product a bit better, so that larger institutions are coming in to fund those transactions, and those conversations are going really, really well. By way of example, $105 billion of mortgage-backed securities trade a week in the US. Those securities they're clipping coupons at 6 or 7% or 8%, somewhere around there,
Mm.
right? It's a good business, right? Would you call it a great business? Probably not a great business, but it's a really good business. You do have a servicing cost and a servicing component to go along with that. The Beeline Equity product, though, since the transactions are done at a 20% discount, the investors are up 20% instantly. And since they're only done in the top 20% zip codes where historical returns or value has increased about 6.5% per year, you're looking at a 26% book value appreciation per year. Now it's book value appreciation versus clipping coupons, but it's 26% versus 6% or 7%. So the industry is starting to wake up a bit and say, well, wait a second, why don't I have 1% or 2% or 3% of my portfolio in this particular product to diversify it, have an equity component to it, and have, an appreciation component to it as opposed to clipping coupons.
So you've opened that up for me. An institution, rather than buying, say, a 10-year, 20-year treasury or MBS mortgage backed security with a long term locked in yield, when baby boomers, maybe they're in their 80s, right? Not living much past 90. This is a brand new asset class, but with a much higher rate of return.
Much higher rate of return, and they're doing their analytics very similar to how life insurance is calculated at the end of the day, right? When you calculate a life insurance policy, you calculate the life expectancy in order to determine, the return. Those guys are doing the same thing over there too. They're looking at the transactions and they're saying, "Okay, here's the data, from the individual and from the property owner, and this is the expectancy," and that's how they've come up with their pricing model at the end of the day. So you're right, it's a longer term, but it's not necessarily a lot longer term, right? Because in mortgage-backed securities, people are refinancing every 7 to 8 to 9 years. So you've got that, versus this is a little longer, that Beeline Equity product is a little longer than the mortgage-backed security piece. But at the end of the day, the capital appreciation, our return is so much greater.
Yeah. Investors will forecast when you're going to turn cash flow positive. It's always a marker, isn't it? But can you give us any color surrounding a date when you might be cash flow positive?
Yeah, listen, that's a question that that we get all the time, obviously. And I think, if we didn't have Beeline Equity and we were just tied to interest rates, right? I couldn't really give an answer because it really depends on when interest rates are going to come down. It's not just for Beeline, it's really almost everyone out there, right? And so since we don't know when the rates will come down, I would say that the answer to that question by almost every single mortgage lender out there that's not making money, which is most of them, would be, let me know. You tell me when rates are going to come down, and then I'll tell you when we're cash flow positive. Or maybe a better response from them would be, you tell me when inflation's going to cool and the war is not here and rates are down, and then I'll tell you when I'll be cash flow positive. But from a Beeline perspective, since we have Beeline Equity, which we just talked about, which is not tied to interest rates, and we're the only company that has that product out there, we are a bit different. We can come back and make a statement that I do expect us to be cash flow positive, I would say, by late Q3 or early Q4, because we have that product. That product is unique. It's got a huge addressable market, and that's what our projections are.
Yeah, got it. So until that point, then, do you need cash on the balance sheet in terms of G&A? How are you handling that?
We decided not to do a registered direct. We have a really strong ELOC partner in CM Capital. They're Series A investors. They're long-term investors. They love what we're doing, and we have an ELOC facility with them.
So that's an equity line of credit.
Yeah.
And that's a rolling agreement.
Yeah. It's a rolling agreement. When you do a registered direct, as you know, it's a finite price. It's a certain period of time. It's a dilutive event, right? Our ELOC partner is CM Capital, and we've got a facility with them that allows us to economize a better stock price over time. And we have the ability to hit that for whatever amount we need in order to get ourselves to cash flow positive. Now, we may do a registered direct if we feel that's the right move at some point in time between now and then. As of right now, we don't have a plan to do that. We plan just to hit our ELOC with our partner who basically wants long-term shares. They don't want short-term shares.
A long-term shareholder who's basically adding to his holding.
They may sell some shares, but they're not going to sell all the shares, and they're going to sell a small percentage. They're going to be up against their blocker from time to time. And so they have to make sure that they don't hit the blocker and they'll go over the blocker. And if they do, they'll sell some shares. So, but I don't think they're going to be selling a lot of shares because they're long-term in nature. They've been long-term in nature and they're good partners.
So can we address the total addressable market?
Yeah, I tell you, that's a good question, man. What you're basically saying to me is you missed that, Nick, in a really polite way, and come back and answer that question. Yeah. So look, in the top 20% zip codes is about a $15 trillion of equity that are locked in, right? And so that's the addressable market in those top 20% zip codes. If you look at all the US, it's like 40 trillion, but we're all focused on the 15 trillion.
Okay.
You
Is
know,
enough to go at?
now let's bring this back to cash flow positive now. And let's bring this back to 700 transactions a month is a $100 million run rate. When you start talking about when can you get to that milestone, well, with this particular product, we can get there a lot faster. And you start thinking about cash flow positive. That's why I said, the end of Q3, the beginning of Q4, because of this product and because we're not tied to interest rates, because we're not sitting around waiting for that rate to come down like every other mortgage lender in order to be cash flow positive.
Let's look ahead. What's on the horizon? Are there any catalysts we can look forward to?
Yeah, well, look, I mean, today we filed an 8K and set up a special committee. This is in the public record. That special committee is looking at the prospects of strengthening the relationship between TYTL, the Beeline Equity partner that we have, and Beeline through Beeline making a strategic investment in that company or maybe even acquiring that company. And so that's pretty exciting, right? At the end of the day. Now, we'll see where that goes, but I'm not involved in that decision because we have a special committee that's looking at that. And so that's really exciting. Other things that are on the horizon as well is to continue the development of our AI, to continue to take the mortgage process and condense it down from 45 to 60 days is the standard. We're at about 20 days average, right? And so we want to continue to bring that down lower and lower. We want to continue to make the mortgage process more seamless. We want to continue to make the mortgage process 24/7 and have this diversified platform. We'll probably be adding some more products to the platform as well that are kind of in the drawing board right now, so we can continue to distance ourselves from the field of mortgage lenders. And again, think about what products are very topical that are relatable and there's a void in the marketplace for. We know Beeline Equity fits a really specific need, and there are other products out there, especially in the luxury home space, that we're thinking about to add to the platform. So those are the three things I would say: potential acquisition of TYTL, enhancing our platform to add more products, and continuing the development of the AI.
Amazing. Nick, thanks so much for joining me today. Actually quite excited about the opportunity here, and I'd encourage everyone just to check out makeabeeline.com, and you're listed on the NASDAQ under the ticker BLNE. Wonderful. Thanks so much for joining us. And as I say, I'm interested in the story, and my broad brush approach to investing is really, when I like the thesis of something, I'll stick it out. And so please come back, Nick, and give us some updates in the not too distant future.
Hey, this has been a lot of fun, Flight. I'll tell you, I really like your interview style. I'm on a lot of podcasts, and your nature is very relaxed. I tend to be more sort of over the top. And so I really enjoyed this because you made me feel very relaxed, and I felt like we had a really good outcome. So thank you very much.
Okay, thanks, Nick. Let's appreciate that. Do please hit the like and subscribe button. It does help us do what we do. And it just also helps these companies that we focus, give them some more visibility if you share it to your friends. And especially in this perhaps new area for Flight's investment server, we're reaching into a different kind of market segment. But I do think this is going to be structurally valuable in my portfolio. So thanks again. See you all soon.
Thank you from all the crew here at the Flight Deck, and hope to see you soon over at Flight's investment server, sharing industry insights for the good of all.